Most retail traders don't lose money because they're wrong about market direction. They lose money because they can't stop clicking the buy button. That single compulsion destroys more trading accounts than any market crash, any black swan event, any economic recession ever will. You are not being beaten by the market. You are being beaten by your own need to be constantly involved. Right now, somewhere in the world, an amateur trader is placing his 15th trade of the day. He's sitting at his desk, eyes burning from 8 hours of staring at candles. He started the morning with a plan, maybe even a watch list of quality setups. But then he took a small loss at the open. Then he tried to make it back immediately and took another loss. Now the P&L at the bottom of his screen shows minus $800 for the week. His pulse is elevated. His vision is tunneling. He's no longer analyzing the market. He's fighting it. He tells himself he's staying active in the market. The professionals have another name for it: systematic account suicide. Here's the brutal mathematics that most people never stop to calculate, and it will shock you. If you make 30 trades per week at 1% risk each, you need a 65% win rate, just to break even after commissions and slippage. Not to make money, just to break even. That's not trading. That's running on a hamster wheel that gets faster every day. Between commissions, the bid-ask spread, and the inevitable slippage on entries and exits, you don't need a 51% win rate to keep your head above water. You need to be right almost 2/3 of the time just to end the week with the same amount of money you started with. Think about that reality for a moment. The best hedge fund managers and professional speculators in the world often operate with win rates between 40 and 55%. They make their fortunes by winning big when they're right and losing small when they're wrong. But the overactive day trader is trying to achieve a 65% strike rate just to survive. The financial industry loves this. Your broker profits from every trade you make, win or lose. The apps on your phone are gamified with flashing lights and one-click execution to keep you clicking. They want volume. They want churn. They want you treating the financial markets like a slot machine, because in that game, the house always wins. Professionals operate by entirely different rules. Jesse Livermore, the greatest speculator who ever lived, sometimes made 3 trades in a month, not 3 per day, 3 per month. And those 3 trades often generated more profit than most traders see in a year of frantic clicking. Livermore operated in an era without computers, without high-frequency algorithms, without instant news feeds. Yet he extracted millions from the tape, while modern traders with supercomputers in their pockets can't hold on to a few $1,000s. The gap isn't technology. The gap isn't information. The gap is identity. Livermore understood that the market spends most of its time in noise. It chops, it ranges, it shakes people out. Only rarely does it enter what he called a pivotal point, where genuine directional movement begins and fortunes are made. He knew that if he was constantly in the market, he would lose his objectivity. He would get chopped up by the noise. So he waited. He sat in cash. And when he finally struck, he struck with such precision and size that those few trades changed his life. Amateurs mistake activity for progress. They have been conditioned by society to believe that if they aren't doing something, they aren't working. In a normal job, if you sit at your desk and stare out the window for 6 hours, you get fired. In trading, if you sit at your desk and do nothing for 6 hours because there's no confirmed setup, you are doing your job perfectly. You are protecting your capital. But the amateur feels anxiety when he's flat. Every minute he isn't in a trade feels like money left on the table. He sees a green candle and thinks he's missing out. He sees a red candle and thinks he should be short. This is the cycle that destroys accounts. Loss leads to urgency. Urgency leads to poor selection. Poor selection leads to more losses. Professionals understand that cash is a position. Not just any position. The most powerful position you can hold. When you're in cash, you have zero stress. You have zero risk. You have total clarity. Cash gives you the flexibility to strike when the odds are overwhelmingly in your favor, instead of constantly defending mediocre entries made from boredom or fear of missing out. Think about a sniper. A professional sniper doesn't fire 100 rounds hoping one hits the target. He waits for hours, sometimes days, for perfect conditions, perfect visibility, perfect wind, perfect angle. Then he takes one shot. That's how professionals trade. Let me show you what this looks like in practice. It's Tuesday morning. The amateur opens his platform at 9:30 sharp and immediately feels pressure to act. Within 15 minutes, he's in two positions, a momentum play on the 5-minute chart and a reversal setup because yesterday's sell-off looked overdone. By 10:15, both trades are underwater. Now he's in damage control mode, watching every tick, hoping one will turn around. The professional sees the same setups. He evaluates the momentum play, but notices volume hasn't confirmed the breakout yet. He passes. He considers the reversal, but sees no clear catalyst for the turnaround. He passes. By 10:15, when both setups have failed, the professional has lost nothing while preserving his capital for genuine opportunities. This week we're conducting an experiment that will rewire your trading psychology forever. You get 3 trades. That's it. 3 bullets in your chamber for 5 full trading days. When you know you only have 3 shots, everything changes. You stop shooting at shadows. You stop taking marginal setups just to feel productive. You become selective. You become patient. You start hunting instead of hoping. When you have unlimited ammunition, you shoot at everything. But when you're down to 3 bullets, you don't fire until you're absolutely certain you can hit the target. This scarcity forces you to filter out the garbage. Suddenly, that okay setup you would usually take doesn't look good enough anymore. You look at it and ask, is this worth one of my 3 bullets? If the answer is anything other than a resounding yes, you wait. But to hunt successfully, you need to know exactly what separates a trade worth taking from the noise that destroys accounts. You need specific criteria that tell you when to pull the trigger and when to keep your finger off it. Most traders are pulling the trigger before they even see the target. They're trading on hope, on patterns that look good, on setups that might work. Professionals don't trade maybes. They trade confirmed pivotal points where the market has already shown its hand. And that's exactly what we're going to build together, starting right now. Jesse Livermore had one unbreakable rule that guided every trade he ever made, from his teenage years reading the bucket shop tape to his legendary short position during the 1929 crash. The market must prove itself before he committed serious capital. Not his opinion about what should happen, not his analysis of fundamentals or chart patterns, not his gut feeling about where price should go next. The market's actual behavior had to speak clearly, loudly, and without ambiguity before Livermore would risk a single dollar. This sounds simple when you hear it stated plainly, but it goes against every instinct that traders develop when they first discover the markets. When you learn technical analysis, when you study chart patterns and support and resistance, you're essentially learning to predict. You're learning to look at current price action and project what comes next. A triangle pattern suggests a breakout is coming. A consolidation near resistance suggests an upward explosion is imminent. Your entire education as a trader teaches you to anticipate, to get ahead of the move, to position yourself before the crowd realizes what's happening. Here's how amateurs think when they see a setup developing. They look at a stock that has been consolidating near resistance for 3 or 4 days. Volume is contracting, which they've learned means energy is coiling up for a big move. The chart pattern looks textbook perfect, exactly like the examples in the trading books they've read. Their thought process goes like this. This stock looks ready to break out. The pattern is perfect. If I wait for the breakout, I'll miss the best entry price. I need to get in now, before everyone else notices, so I can catch the whole move. They buy on anticipation, hoping to outsmart the crowd and capture every penny of profit from the very bottom of the launch pad. Here's how professionals think when they see the exact same setup. They look at the same stock consolidating near the same resistance. They see the same contracting volume and the same textbook pattern. But their thought process is fundamentally different. This stock might break out. The setup looks good. But I've seen 1,000 setups that looked good and then failed. I'll wait until it actually breaks out, then I'll enter with confirmation. Yes, I'll sacrifice the first 2% of the move. I'll miss those initial gains. But by waiting, I avoid the majority of false breakouts that never materialize. I avoid the failed patterns that trap early buyers and turn winning setups into losing trades. The difference comes down to this fundamental identity shift. Amateurs want to be right. Professionals want to be profitable. The amateur's ego is invested in predicting the future correctly. He wants to tell his friends he bought before the breakout, He wants to feel smart, to feel like he saw something others missed. The professional doesn't care about being right. He cares about making money. And he knows that being slightly late but confirmed is infinitely more profitable than being early and wrong. Let me show you exactly what this looks like in practice, day by day, decision by decision. It's Tuesday morning. You've been watching a particular stock for the past week. It's been consolidating in a tight range just below a key resistance level at $52. For 3 full trading days, the stock has tested this level multiple times, but hasn't broken through. Volume has been declining each day, which classic technical analysis teaches means a breakout is imminent. The setup looks textbook perfect. The amateur looks at this setup and enters immediately on Tuesday morning. He buys at $51.75, just below resistance. He's convinced he's identified the pivot before the crowd notices. His logic seems sound. I'm getting the best price. When this breaks out, I'll already be in. I'll capture the entire move while everyone else is chasing. He places his order, gets filled, and now he waits for the market to prove him right. The professional looks at the exact same setup and does nothing. He sees the consolidation. He sees the declining volume. He sees the proximity to resistance. He acknowledges that yes, this could break out. But could isn't good enough for someone with only 3 bullets in his chamber for the entire week. He watches from the sidelines, capital preserved, stress at 0. Wednesday arrives. The stock opens and immediately tests the $52 resistance level. For a brief moment, it looks like the breakout is happening. The amateur feels vindicated, but then something happens that occurs in most attempted breakouts. The stock taps resistance and pulls back. By midday Wednesday, the stock is trading at $51.25. The amateur who bought at $51.75 is now underwater by 50 cents per share. He's not panicking yet, but he's uncomfortable. He's hoping his analysis was correct. He's hoping the breakout is just delayed, not canceled. He's managing stress and doubt instead of managing profit. The professional remains flat. He saw the failed breakout attempt on Wednesday. He took notes. He observed that volume wasn't particularly strong when price tested resistance. The market tried to break out and failed. That's information. That's the market speaking. And what it said was, not yet. Not enough buying pressure. This level is still holding. The professional's capital remains untouched. His psychological state remains clear. He continues to watch. Thursday morning arrives, and now something different happens. The stock opens strong and immediately pushes through the $52 resistance level. But this time, volume is different. This time, buying pressure is unmistakable. The stock doesn't just tap resistance and fall back. It breaks through decisively on volume that's 3 times the recent average. By mid-morning, the stock is trading at $52.40. By the afternoon, it's at $52.75. And crucially, it holds these gains into the close, proving the breakout has substance. Now, and only now, does the professional enter. He buys at $52.50. Think about this carefully. The professional paid 75 cents more per share than the amateur's Tuesday entry. On the surface, it looks like the amateur got the better deal. But examine what each trader actually bought. The amateur bought hope and spent 2 days suffering through a drawdown, watching his position move against him, questioning his analysis. The professional bought confirmation. He bought evidence that the market had chosen a direction. He bought proof that the resistance level had been broken and could hold. He paid a premium for information. This is the key insight most traders never grasp. You're not just buying shares of stock. You're buying information about market behavior. The professional willingly paid 75 cents more per share because that premium purchased something invaluable, certainty that the move was real. The amateur got a better price, but bought uncertainty, stress, and the high probability of being wrong. This single filter, waiting for the market to show its hand first, eliminates a significant portion of losing trades. Most setups fail. Most breakouts are false. Most patterns abort before completion. Most consolidations resolve in the opposite direction of what the pattern suggests. You cannot predict which specific setups will work and which will fail. Your technical analysis cannot tell you in advance. Your indicators cannot tell you. Your gut feeling cannot tell you. but you can wait for the market itself to tell you. Livermore called these moments pivotal points. These weren't just arbitrary price levels on a chart. A pivotal point was a specific psychological moment where price and volume action combined to signal that the line of least resistance had changed. It was the moment when the market's intention became clear, when genuine buying or selling pressure revealed itself, when the dam finally broke. Livermore would watch a stock for weeks, tracking every reaction to news, every test of support or resistance, gathering data. But he wouldn't bet a dime until the stock hit that pivotal point, the exact moment where the move was confirmed to be real. Your job as a trader isn't to predict when these pivotal points will occur. Prediction is the amateur's game, and it's a losing game. Your job is to recognize pivotal points after they've begun and then ride them with appropriate position size. You're not trying to be the first person in the trade. You're trying to be the person who makes money on the trade. When you operate this way, you're no longer fighting the market or arguing with price action. You're not volunteering to be the market's test subject, letting it use your capital to decide whether it wants to move or not. You let other traders absorb the false starts, the failed breakouts, the random whipsaws. Only when the market has passed those tests do you step in. You become what I call a confirmation trader, someone who trades evidence, not expectations. The amateur asks, how can I get in before everyone else? The professional asks, how can I ensure the market is moving in my favor before I risk a dollar? One seeks to be early, the other seeks to be aligned. One is fighting the tape, the other is following it. 3 trades per week means 3 confirmed pivotal points, not 30 guesses based on what might happen. Not 15 hopeful entries on patterns that look ready. 3 specific moments where the market has already revealed its intention, and you're simply following the evidence it provides. When you know you only have 3 bullets for the entire week, you can't afford to waste one on a maybe. You need proof. You need to see the breakout happen with volume. You need to see the price hold above the level. You need to see the market choose a direction before you choose a side. This is where your identity begins to shift from predictor to follower, from fortune teller to detective. You don't get paid for guessing what will happen. You get paid for reading the evidence as it appears and acting decisively when the case is strong. The market will tell you everything you need to know, but only if you're patient enough to listen and disciplined enough to wait for its answer. Most traders are pulling the trigger before they even see the target clearly. But when you embrace confirmation over prediction, when you're willing to pay a small premium for certainty, when you understand that cash is a position of power rather than missed opportunity, everything changes. You stop fighting the market and start dancing with it. And that's when trading transforms from gambling to genuine edge-based speculation. You can be right about market direction and still lose money. That sounds impossible until it happens to you 3 or 4 times in a row, leaving you staring at your screen in bewilderment. You correctly predicted the breakout. You saw the sell-off coming. Your analysis was spot on. Yet somehow, your account balance is smaller than when you started the week. That's the harsh lesson most traders learn after blowing through their second or third account. The problem isn't their analysis. The problem is their mathematics. Specifically, the deadly combination of poor position sizing and excessive trade frequency that creates a structural disadvantage no amount of market insight can overcome. Think of trading like running a business where your expenses are slowly killing you. Every trade you place carries hidden costs that don't show up clearly on your monthly statement, but drain your capital like a slow leak. Commissions, even when advertised as 0, are embedded in the bid-ask spread. Slippage eats at your entries and exits as your orders get filled at slightly worse prices than expected. But the biggest cost is invisible, the psychological energy required to make dozens of high-stakes decisions every week. Decision fatigue sets in by Tuesday. By Thursday, you're exiting winners too early because you're mentally exhausted and holding losers too long because you're frustrated and hoping for a reversal. Here's the brutal mathematics that separate professionals from amateurs, and I want you to absorb these numbers because they explain why most retail traders fail within 6 months. If you make 30 trades per week at 1% risk each, you need a 65% win rate just to overcome commissions, slippage, and the psychological toll of constant decision-making. Think about what that means. You're not trying to achieve a 65% win rate to get rich, or even to make modest gains. You need that win rate just to tread water, just to end the week with roughly the same capital you started with. That 65% requirement isn't theoretical, it's mathematical reality. With 30 trades, you're paying the friction costs 30 times. The spread takes a bite on each entry and exit. Slippage costs you a few cents here and there. Occasionally, a trade gaps against you and your 1% risk becomes a 2% loss. Some trades scratch out near break-even, meaning you paid commissions for nothing. When you add up all these small leaks across 30 trades, you need to win almost 2/3 of them just to stay even. That's exhausting. That's unsustainable. That's why most retail traders burn out not from losing, but from the constant grind of managing chaos they've created through overtrading. Now consider the professional's approach, and notice how radically different the mathematics become. 3 trades per week, at 2 to 3% risk each, with a 70% win rate, because you're only taking confirmed setups that have already proven themselves. Your expectancy isn't just higher, it's actually achievable. A 70% win rate sounds difficult until you realize you're only taking 3 trades per week, each one filtered through multiple confirmation criteria. You're not trying to win 7 out of 10 random trades. You're trying to win 7 out of 10 cherry-picked, market-confirmed, high-probability setups. You have time to think. Time to manage positions properly. Time to let winners develop without constantly monitoring 10 different positions across multiple time frames and sectors. Your attention isn't scattered. Your capital isn't fragmented. Your psychological energy isn't depleted by noon on Monday. You're operating with the focus and clarity that comes from knowing you don't need to trade unless conditions are perfect. Jesse Livermore understood this instinctively long before modern portfolio theory existed. He didn't scatter his capital across dozens of stocks hoping one would work. He didn't diversify for the sake of activity. He concentrated firepower. When Livermore identified a genuine pivotal point, when all his filters aligned and the market was screaming a clear directional message, he went in with meaningful size. Not reckless size that could destroy him if he was wrong, but calculated size that would make a real difference to his wealth when he was right. He knew that diversification is often just a fancy word for lack of conviction, and conviction backed by confirmation is where fortunes are made. Let me show you exactly what this looks like in practice, walking through a complete trading week. It's Monday morning. The market opens with mixed signals. The S&P is up slightly. The Nasdaq is down. Technology is weak while energy shows some strength. You scan your watch list of 20 stocks you've been tracking. You see several interesting patterns. A few stocks testing support, one approaching resistance, another showing unusual volume. But nothing meets your confirmation criteria. Nothing has broken out with authority. Nothing has clearly revealed the market's intention. So you trade nothing. You watch. You take notes. You preserve your capital and your psychological energy. The amateur sees this same market and forces 2 trades by 10 in the morning because he feels pressure to be active. He tells himself he's staying engaged with the market, but what he's really doing is paying tuition to learn lessons he could observe for free from the sidelines. Tuesday brings sector rotation. Money flows from technology into energy and financials. You watch several energy stocks rally, but they're already extended from yesterday's breakout. You missed that entry, and that's fine. You're not chasing momentum that's already moved. You notice a few other setups developing on your watch list, but they're still in the anticipation phase. They haven't triggered yet. The patterns look promising, but the market hasn't confirmed them. The amateur sees the energy sector's strength and jumps into 3 different energy stocks, hoping to catch the momentum. By the close, 2 of his 3 trades are underwater because he bought strength that immediately reversed. Wednesday morning changes everything. One of the stocks on your watch list, a name you've been tracking for 3 weeks, finally breaks out of a month-long consolidation. The breakout happens on volume that's triple the recent average. Price doesn't just barely creep above resistance, it smashes through it with authority and holds. By mid-morning, the stock has moved 4% above the breakout point and shows no signs of fading. This is your moment. This is what you've been waiting for. This is a confirmed pivotal point. But even now, you don't simply shove all your chips into the middle of the table. You enter with what I call a testing position, roughly half of your intended size for this trade. Let's say you've decided this setup is worth 3% total risk based on your conviction level and the quality of the confirmation. You enter with 1.5% risk first. Your stop loss is clearly defined, placed just below the breakout level where the pattern would be invalidated. This testing position isn't your full commitment. It's your way of asking the market a question. Is this breakout real, or is this another false start that will fade by tomorrow? You're not betting the farm on your analysis. You're putting a probe into the market to gauge its temperature. If the price immediately reverses and hits your stop, you take a small, manageable loss on half size. You were wrong, but you're not hurt. You still have most of your intended risk capital available for the next genuine opportunity. Thursday morning arrives, and the market answers your question with unmistakable clarity. The stock gap's higher at the open, not a small gap that immediately fills, but a meaningful gap of 2% that holds and extends. Volume remains strong. Every small dip is bought aggressively. The momentum is undeniable. The breakout is proving itself to be genuine, not just a temporary spike that fades. Now you add the second half of your position. You're pyramiding into strength, not into hope. You're adding to a winner, which is one of the few times in trading when adding to a position makes mathematical sense. This is the art of pyramiding that amateurs get backwards. Amateurs add to losers, hoping to lower their average cost and get out at break even. They throw good money after bad. Professionals add to winners, pyramiding into confirmed moves where the market has already shown its hand. You're not doubling down on a guess. You're increasing your bet after the market has started paying you. By Friday, look at the stark difference in your trading lives. You're managing one meaningful, high-conviction position. You're calm. You're focused. You understand exactly why you're in this trade and what you're watching for. If the trade continues to work, you'll make a significant return because you concentrated your capital on a confirmed opportunity. If it reverses, you have a clear plan to protect your profits and limit your losses. Meanwhile, the amateur who made 30 trades this week is drowning in chaos. He's lost money on 22 of them, mostly small losses, but they add up like water through a cracked dam. He made small profits on 6 trades, usually cutting them short out of fear that they'd reverse. He broke even on 2 trades, which means he paid commissions and spread costs for nothing. By Friday afternoon, he's down money for the week. More importantly, he's emotionally bankrupt. His brain is fried from hundreds of micro-decisions. He can barely remember why he entered half of those 30 trades. He's been managing chaos, not executing a plan. You've made one trade sequence. Whether it wins or loses is almost secondary to the process. If it wins, the gain is meaningful, because your position size was meaningful. A 3% risk position that moves in your favor by 50% gives you a 1.5% account gain from a single trade. That's the kind of return that compounds into real wealth over time. If it loses, the loss is contained and clearly defined, and you still have 2 more bullets in your chamber for the week. This is the mathematics of concentration. When you risk meaningful amounts on high probability, confirmed setups, you're not just trading differently, you're playing an entirely different game. A portfolio of mediocre trades dilutes your edge. A concentrated portfolio of high-conviction trades magnifies it. You cannot get rich betting small amounts on random noise. You get rich by betting meaningful amounts on confirmed trends. The testing position strategy solves the biggest psychological hurdle in trading: fear of entry. Many traders are afraid to enter because they fear taking a full-sized loss, so they hesitate, and then they chase. By using a testing position, you lower the barrier to entry. You're only dipping your toe in the water first. Once the water proves to be warm, once the market confirms you're right, then you dive in with full size. This allows you to be aggressive when you should be, and defensive when you must be. When you trade less, you see more. When you're not distracted by 5-minute candles and tick-by-tick noise, you can see the larger structure of the market. You can see the forest while the amateur is running into every tree. The amateur believes that more trades equal more chances to win. The professional knows that more trades equal more ways to lose. Every time you click the buy button, you're exposing yourself to market risk, execution risk, technology risk, and emotional risk. Why would you expose yourself to those dangers 30 times a week for setups that are mediocre at best? It makes no mathematical sense. By limiting yourself to 3 trades and using the testing position strategy, you align the mathematics of the market in your favor. You're no longer fighting the law of large numbers. you're using it. Quality compounds. Quantity depletes. That is the immutable law of professional trading. The amateur seeks the dopamine hit of constant action. The professional seeks the quiet satisfaction of perfect execution. Stop trying to catch every ripple in the pond. Wait for the wave, and when that wave comes, don't just watch it. Ride it with everything you have, safely, methodically, and professionally. That's how accounts are built. That's how trading careers survive and thrive in a game where most participants fail within their first year. The hardest part of trading isn't pulling the trigger. It's keeping your finger off it when every instinct in your body is screaming at you to act. This is the psychological battle that destroys more trading careers than bad entries, poor risk management, or lack of capital ever will. You can teach someone chart patterns in an afternoon. You can explain position sizing in 20 minutes. But teaching someone to sit on their hands when the market offers nothing of value? That rewires decades of evolutionary programming and social conditioning about what productive work actually looks like. Amateurs experience waiting as psychological torture. They wake up Monday morning, brew their coffee, sit down at their desk, and open their trading platform at market open. Within seconds, they feel pressure building in their chest. The market is moving without them. Green candles are flashing on some stocks. Red candles are dropping on others. Their Twitter feed shows traders posting screenshots of winning positions. Their Discord group is buzzing with trade ideas. The sensation becomes physically uncomfortable, heat in the chest, tightness in the throat, a buzzing in the head that won't stop. Their heart rate elevates. Their breathing becomes shallow. This isn't just mental pressure. It's a full-body stress response triggered by the fear of missing out. We are wired by evolution to act, to hunt, to gather, to build, to fight. For thousands of years, action equaled survival. Inaction meant death. But in the financial markets, this evolutionary programming becomes a liability. The amateur has also been conditioned by society to believe that if you're not doing something, you're not working. In a normal job, if you sit at your desk and stare out the window for 6 hours, you get fired. So when they open their trading platform and see an empty position screen, their brain interprets this as failure, as laziness, as missed opportunity. The amateur has made a fatal identity-level error. They've linked trading with being in a trade. If they're not in something, they feel like they're not really a trader. If every day doesn't end with at least one position opened and closed, they label the day a waste. This internal narrative is deadly because it drives them to manufacture trades out of boredom, to invent reasons to click buttons, to chase noise just to feel productive. They trade not because they've identified a confirmed pivotal point, but because sitting still feels like professional failure. Professionals experience waiting in an entirely different way. They have completely rewired their relationship with inactivity. They understand that patience isn't passive, it's an active, strategic position of maximum power. When a professional sits in cash watching the market, he's not being lazy. He's actively preserving capital. He's actively maintaining psychological clarity. He's actively positioning himself to strike when genuine opportunity presents itself. Every moment you're not in a bad trade is a moment you're winning the game. Every marginal setup you pass on is a potential loss you've avoided before it could damage your account or your confidence. Think about this reframe carefully, because it changes everything. When you enter a mediocre trade, a setup that looks okay but doesn't meet your highest standards, you're not just risking the capital you've allocated to that position. You're also creating opportunity cost. That capital is now locked up in a mediocre idea, unavailable when the genuine opportunity appears an hour later or the next day. You're also spending psychological energy managing that position, monitoring it, worrying about it, making micro decisions about whether to hold or exit. All of that mental bandwidth is now consumed by a trade that was questionable from the start. The professional who passed on that mediocre setup, he's paid zero in commissions. He's experienced zero stress. His capital is fully available. His mind is clear and focused. He's ready. That's the true power of the cash position. Cash isn't what you hold when you can't find anything to trade. Cash is your default state, your position of maximum power, your launching pad for when conditions align perfectly. Jesse Livermore said it more plainly than anyone in history, and this quote should be burned into every trader's memory. It never was my thinking that made the big money for me. It always was my sitting. He wasn't being poetic or philosophical. He was describing the actual, mechanical skill that separated him from the millions of failed speculators of his era. Livermore's analysis was often correct, but it was his ability to sit tight and do nothing until the exact right moment that allowed him to capture the big moves. He understood that the market spends 80% of its time in noise and confusion. Trying to trade that 80% is a fool's errand that enriches brokers and impoverishes speculators. The money is made in the 20% of clear, directional movement. And you have to sit through the noise to catch the signal. Let me walk you through a scenario that plays out in trading rooms and home offices around the world every single week, because understanding this sequence is crucial to your psychological transformation. It's Wednesday afternoon. The week is half over. You've been watching the market since Monday morning. You've scanned your watch list multiple times each day. You've seen several interesting patterns develop, a few stocks testing support, one approaching resistance, and others showing unusual volume. But none have triggered your confirmation filters. None have reached that pivotal point where the market shows its hand clearly. You've made 0 trades so far this week. Your trading log is empty. Your P&L shows a flat line. The amateur looks at his empty trading log and panic sets in. His internal dialogue sounds like this: I'm a trader. Traders trade. It's Wednesday and I haven't made a single trade. Other people are making money. I see the posts, the screenshots, the commentary about big wins. Am I missing something? Am I too cautious? Maybe my filters are too strict. Maybe I'm overthinking this. I can't make money sitting in cash. This internal pressure builds like steam in a kettle until it becomes unbearable. The amateur starts scrolling through lower time frames, looking for anything that resembles a setup. He zooms into 5-minute charts. He convinces himself that a minor intraday pullback is actually a major opportunity. The stock isn't at a genuine pivotal point. Volume isn't confirming. The larger trend isn't clear. But he can't stand the feeling of doing nothing, so he forces a marginal trade just to feel productive, just to silence the voice telling him he's failing as a trader. For a brief moment, the market might even cooperate. The position goes slightly in his favor, and he feels vindicated. See? I knew I needed to get involved. But because the trade wasn't built on strong confirmation, because it was born from psychological pressure rather than market evidence, the slightest shift in sentiment flips the move against him. By Thursday morning, he stopped out at a loss. Now he's not only down money for the week, he's also emotionally fragile. He feels behind. He feels the need to make it back before Friday's close. That forced Wednesday trade doesn't just cost him capital, it hijacks his ability to think clearly about future opportunities. The professional looks at the same empty trading log on Wednesday afternoon and feels something completely different: deep satisfaction. His internal dialogue sounds like this: I've avoided 5 mediocre setups this week. Each one looked okay at first glance, but none met my confirmation criteria. That stock that tested support on Monday, it bounced weakly and faded. That breakout attempt on Tuesday, volume was anemic, and it reversed by noon. By passing on these marginal opportunities, I've preserved my capital. I've kept my mental state clear and focused. I haven't lost a dime to boredom or social pressure. I'm not down money from forced trades. I'm not managing stress from questionable positions. I'm ready for what comes next. Friday morning arrives, and the market's character changes completely. A stock on his watch list that has been coiling in a tight range for 3 weeks finally explodes out of its base on massive volume, not just heavy volume, but volume that's triple the recent average. The breakout doesn't just barely creep above resistance, it smashes through with authority and holds its gains. Price doesn't fade or reverse, it continues higher throughout the morning session. This is a genuine pivotal point, the kind of setup Livermore would have recognized instantly. The professional sees it clearly because he's fresh, focused, and fully capitalized. He hasn't depleted his psychological energy on mediocre trades. He hasn't locked up his capital in marginal positions. He enters with size and confidence, because this setup meets every one of his criteria. But what about the amateur who forced that trade on Wednesday? He's now in one of 2 equally bad situations. Either he's still managing that losing position from Wednesday, hoping it will turn around so he can get out at break even, which means he's distracted and possibly undercapitalized when Friday's genuine opportunity appears. Or he took his stop loss on Thursday, which means he's down money for the week and psychologically hesitant to take Friday's setup that actually works. He's gun-shy now. He's questioning his judgment. The one trade he should take with full size and conviction, the trade that meets all his criteria, he'll probably pass on or take with reduced size because he's been beaten up by the trades he shouldn't have taken. This is the compounding effect of patience versus impatience that most traders never understand. Good decisions compound into better situations that make future good decisions easier. Bad decisions compound into worse situations that make future good decisions harder. Each marginal trade you avoid keeps you in a position of strength. Each forced trade weakens you slightly, making the next decision more difficult and the next mistake more likely. Here's the psychological shift that changes everything, and I need you to really absorb this because it goes against everything society has taught you about work and productivity. Stop measuring your success by trades executed. Start measuring it by bad trades avoided. This is the professional's actual scorecard, the metric that separates long-term survivors from the 90% who quit within 2 years. At the end of each week, the professional doesn't just review his winning and losing trades, he reviews the setups he passed on. He looks at the charts where he almost entered, but didn't, because something was missing. Volume wasn't there. The pattern wasn't clean. The confirmation wasn't strong enough. He tracks how many of those past setups would have been losers if he had taken them. When you reframe success this way, waiting stops feeling like inactivity and starts feeling like victory. Every time you close your platform without trading because the market offered nothing that met your standards, you've had a winning day. You've defeated the psychological pressure to act. You've beaten the fear of missing out. You've beaten the voice telling you that activity equals progress. Those are real wins that compound into long-term survival and prosperity just as surely as compound interest grows your savings account. Waiting is a position, not just any position, but the most powerful position you can hold. When you're in cash, you have optionality. You can go long or short on any stock, in any sector, on any time frame. You have maximum flexibility and zero stress. You're not hoping the market agrees with your current position. You're not defending anything. You're not managing risk on an existing trade. You're simply ready, like a predator, waiting in tall grass. The market has to come to you. It has to show you its hand. It has to prove it's worthy of your capital before you'll engage. The moment you enter a trade, you lose that control. You become a participant rather than an observer, subject to the whims of price and volume. Your objectivity becomes compromised because you now have skin in the game. Why would you give up your position of power for anything less than a setup that screams opportunity? Your 3-trade limit for this week isn't a restriction designed to handicap you or make trading harder. It's a psychological filter that makes patience easier by creating artificial scarcity. It's a lens that forces you to see the market clearly. When you know you only have 3 bullets for the entire week, everything changes. You stop shooting at rabbits. You stop wasting ammunition on distant targets where you're not sure you can hit. You stop firing at shadows and movement in the bushes. You wait for the elephant, the trade so obvious, so confirmed, so clearly aligned with every filter you have, that not taking it would be the actual mistake. Think of yourself as a sniper with only 3 rounds in your rifle. You're in position, watching a valley where your target is known to appear. You see movement in the distance. Is it the target? Maybe. It looks somewhat like what you're hunting for, but it's far away, and the conditions aren't ideal. Do you shoot? Of course not. You have limited ammunition. You wait. More movement appears, closer this time, but it's partially obscured by trees, and you can't get a clean sight picture. Do you shoot? No. You continue to wait, patient and ready. Finally, your target steps into the open, clear as day, standing still, perfect conditions, clean line of sight. Now, and only now, do you take the shot. That's precision. That's professional execution. The amateur sees the 3-trade limit and feels constrained, like he's being prevented from doing his job. The professional sees it and feels liberated. Liberated from the pressure to be constantly active. Liberated from the fear of missing out on mediocre setups. Liberated from the exhausting mental work of managing multiple marginal positions simultaneously. 3 trades means 3 moments of absolute clarity and conviction. That's not restriction. That's focus. That's the difference between spray and pray and surgical precision. The psychological pain of sitting tight is real, but it's temporary. It's the withdrawal symptom of what is essentially a dopamine addiction. You've become addicted to the action, to the feeling of being in the game, to the momentary rush that comes from clicking buy or sell. But that addiction is costing you money. You have to break it. You have to learn to love the boredom of discipline more than the excitement of gambling. Because the excitement of gambling costs you money, while the boredom of discipline makes you rich. This isn't about becoming passive or losing your edge. It's about channeling your aggression and focus into the moments that actually matter. It's about understanding that in trading, unlike in most areas of life, doing nothing is often doing something. It's the hardest work you'll do as a trader, because it goes against every instinct you have about productivity and success. But it's also the work that pays the best over time. So the next time you're sitting there, staring at a screen where nothing is happening, feeling that familiar itch to click something, anything, remember this: you are not being lazy. You are not missing out. You are not failing as a trader. You are doing the most difficult and most important part of your job. You are preserving your capital and your clarity for the moment that actually matters. You are practicing the skill that separated Jesse Livermore from the crowd of failed speculators who came and went during his era. Embrace the silence. Embrace the inactivity. Let the amateurs churn their accounts to zero while you wait, calm and ready, for the setup that can change your month or your year. That patience, that discipline, that ability to sit tight when sitting tight is the hardest thing to do. That's the psychology of the professional trader. That's the foundation upon which all successful trading careers are built. Most traders never train this muscle. They practice entries, exits, and position sizing, but they never practice the art of non-action. They never ask themselves, how good am I at watching a near setup form and not touching it until confirmation appears? So when pressure builds, their default response is always the same: do something, click something, change something. You need to flip that wiring. You need to make non-action your default and action your rare, carefully considered exception. That's when trading transforms from gambling to genuine edge-based speculation, and that's when your 3-trade weekly framework becomes the foundation for long-term success in the markets. You now understand why 3 beats 30. You've absorbed the mathematics that prove concentration beats diversification. You've seen how confirmation eliminates the majority of losing trades. You've learned that patience is a position of power, not a weakness to overcome. The question is no longer why this approach works. The question is how you implement it when every instinct in your body is screaming at you to take that 4th trade, that marginal setup, that just one more opportunity that looks tempting but fails your standards. Here's the complete protocol that professionals use to separate genuine opportunities from market noise. It's simple enough that you can memorize it in 5 minutes. It's rigid enough that it eliminates 90% of the distractions that cost amateurs money every week. And it's uncomfortable enough that it forces you to confront your own gambling impulses before they destroy your account. 3 filters. Every potential trade must pass all 3 before you risk a single dollar. No exceptions. No rationalizations. No, this one's a little different special cases that let you bend the rules when you're bored or desperate. Filter 1 is the clear entry signal, and this is where most traders fail before they even realize they're gambling. This filter demands one thing: an objective, measurable entry trigger that anyone looking at the same chart would identify at the exact same price level. Not it looks ready to move. Not it feels like a bottom is forming. Not the momentum seems to be shifting in our favor. Those are subjective interpretations that change based on your recent trading results, your current mood, and how desperately you want to be in a trade. You need a specific price level, volume confirmation, or pattern completion that you can define with mathematical precision. Here's what a valid entry signal sounds like. If this stock closes above $52.20 on volume greater than 1.5 million shares, I enter at tomorrow's open. That's objective. That's binary. Either the stock closed above 52.20 on heavy volume, or it didn't. Either you have a signal, or you don't. There's no room for interpretation. No gray area where you can convince yourself that $52.15 is close enough. The professional demands that the market cross his specific threshold. If it hits 52.19 and reverses, he does nothing. He doesn't front-run the signal. He doesn't anticipate the breakout. He waits for proof. An invalid entry signal sounds like this. This stock has been consolidating for weeks and looks like it wants to break out soon, so I'll get in now before everyone else notices. That's not a signal. That's a wish dressed up as analysis. What does wants to break out mean in objective terms? What specific price action would confirm that desire? What volume threshold needs to be crossed? Without precise answers to these questions, you don't have a trade setup. You have a hope. And professional traders don't risk capital on hope. Filter 2 is defined risk, and this filter separates disciplined traders from gamblers who are flying blind. Before you even think about potential profit, you must answer two questions in one clear sentence. First, where exactly will you exit if you're wrong? Not approximately where. Not somewhere around that support level. The exact price where your stop loss will be triggered. Second, how much are you risking in dollar terms based on your position size and that stop level? A proper answer sounds like this. My stop loss is at $50.30. With 200 shares, I'm risking $140 on this trade. That's complete. That's professional. You know your maximum loss before you calculate your potential profit. You've accepted the loss psychologically before you even enter the position. This is proactive risk management that allows you to survive the inevitable losing streaks that destroy amateur accounts. If you can't answer both questions before you click the buy button, you're not trading. You're gambling with a plan to figure out your exit later based on how you feel when price moves against you. This emotional approach guarantees that fear will control your exits. When you're losing money and feeling pain, you'll hold too long hoping for a reversal. When you're making money and feeling euphoric, you'll exit too early afraid of giving back profits. Filter 2 eliminates these emotional decisions by forcing you to define risk before entry, not during the heat of battle. Filter 3 is the conviction test, and this is the filter that will save you from the slow, bleeding death of marginal setups. This filter asks the most important question of all. Is this setup good enough that you're willing to risk 3% of your total account equity on it? Not 0.5%. Not 1%. 3%. This is your quality gate, the final checkpoint that forces you to be brutally honest about whether you truly believe in the setup or whether you're just trying to stay active in the market. When you ask yourself if you'd risk 3% on a trade, you're forced to evaluate it through the lens of real consequence. 3% is meaningful money. On a $20,000 account, that's $600. That's rent money or car payment money. When the stakes are real, your brain stops lying to you about mediocre opportunities. If you look at a trade and think, well, it looks okay, but I'm only comfortable risking 1% on this one, what you're actually saying is, this setup isn't good enough, but I want to trade anyway. The professional hears that internal dialogue and makes a different decision. If the setup isn't worth 3%, it's not worth any percent. Pass. Wait for something better. Let me walk you through a complete week using this protocol so you can see exactly how it operates under real market conditions. Monday morning arrives, and you scan your watch list of 20 stocks. You find 8 that look interesting at first glance. Some are approaching key levels, others are showing unusual volume. One has news that might be a catalyst. Your old self would have found reasons to enter at least 2 of these positions. But now you apply the 3 filters systematically. The first stock is approaching resistance, but hasn't broken through yet. Filter 1 fails because you'd be anticipating a breakout, not responding to one. The second stock broke above a key level on Friday, but did so on weak volume. Filter 1 is questionable, and Filter 3 fails because you're not willing to risk 3% on a breakout that lacks conviction. You work through all 8 stocks methodically. Some fail Filter 1 because the entry signals are vague. Some pass Filter 1 but fail Filter 2 because you can't identify a logical stop-loss level. Some pass both but fail Filter 3 because your conviction isn't strong enough to commit meaningful capital. By Monday's close, you've traded nothing. Your account balance is unchanged. Your stress level is 0. Tuesday brings sector rotation and increased volatility. 2 stocks on your watch list break key levels with authority. You get excited, because this might be your opportunity. You apply the filters with disciplined focus. Both stocks pass filter 1 with clear breakout signals. Both pass filter 2 with logical stop placement. But when you reach filter 3, you hesitate. The setups look decent, but the broader market is choppy, and sector leadership is unclear. You ask yourself honestly, would I risk 3% of my capital on this? The answer is no. Your conviction wavers. If you're hesitating at filter 3, the setup isn't good enough. You trade nothing on Tuesday. The amateur is already managing the stress of 2 mediocre positions. You're still in cash, still waiting, still ready. Wednesday morning changes everything. One stock on your watch list that you've been tracking for 3 weeks finally breaks out of its consolidation in unmistakable fashion. The stock doesn't just creep above resistance. It explodes through the level on volume that's triple the recent average and holds its gains throughout the morning session. You apply your filters with laser focus. Filter 1 passes immediately. The entry signal is crystal clear. The stock has broken above $54 on massive volume and is holding above that level. Filter 2 passes without hesitation. You can place your stop at $53, just below the breakout level where the pattern would be invalidated. With your planned position size, you're risking exactly 3% of your account. Filter 3 passes with conviction. You love this setup. The breakout has authority, the volume confirms institutional buying, and the broader market is supportive. You enter your first trade of the week using the testing position approach, half your intended size to probe the market's commitment. Thursday morning, the market answers your question with unmistakable clarity. The stock gaps higher at the open and maintains momentum throughout the session. Every small dip is bought aggressively. The move has staying power. You add the second half of your position, pyramiding into strength after the market has proven the breakout is genuine. You're not adding to hope. You're adding to evidence. Friday arrives, and your job shifts completely. You're no longer hunting for new trades. You're managing one high-quality, high-conviction position. Your focus is entirely on execution, monitoring momentum, watching volume patterns, trailing your stop to protect profits as the position moves in your favor. If the trade continues working, you might use your second bullet for the week to add more size. If it reverses and hits your trailing stop, you'll accept the profit and wait for the next confirmed opportunity. That's the week. One carefully selected, thoroughly filtered, properly sized position. Whether it wins or loses is secondary to the process. You followed a professional protocol. You waited for genuine confirmation. You managed risk with precision. You preserved capital and psychological energy for future opportunities. Meanwhile, the amateur who took every setup that looked interesting is drowning in chaos. He's entered 15 trades by Wednesday, lost money on 11 of them, made small profits on 3, and broken even on 1. By Friday, he can't remember why he entered half of those positions. He's been reacting to price movement instead of executing a plan. He's managing chaos while you're managing clarity. 3 filters per trade, 3 trades per week. That's how quality beats quantity, every single time. That's the formula that transforms gambling into genuine edge-based speculation. It sounds restrictive until you realize it's actually the ultimate freedom. It frees you from the compulsion to be constantly active. It frees you from the stress of managing mediocre positions. It frees you to focus exclusively on the highest probability opportunities the market offers. Your homework is simple, but transformative. Take a sticky note and write 3 trades left in bold letters. Place it on your monitor where you cannot miss it. Every time you look at a chart, every time you feel the urge to click buy, look at that note and ask yourself, is this setup good enough to use one of my 3 bullets? Watch how it changes your perception instantly. Watch how the marginal setups that usually trick you into losing money suddenly disappear from your radar. When scarcity forces selectivity, your standards rise automatically. And when your standards rise, your results follow. This is the path from amateur to professional. It's not easy because it requires conquering your own human nature. But it is simple. 3 filters eliminate the noise. 3 trades per week eliminate the chaos. 1 professional process eliminates the gambling. Master this discipline, and you'll have crossed the divide between the amateur who feeds the market and the professional who feeds from it. The market is waiting. Your 3 bullets are loaded. Now you know exactly when and how to pull the trigger.